For those of you who haven't met me before, I'm a chartered tax advisor and a registered tax agent. I'm also an accredited SMSF specialist advisor and a licensed financial advisor. So I put into practice those pearls that Grant was talking about that are in his book. Does that work? As always, we have to have a disclaimer. So everything I say tonight is for general and education purposes only. It is not intended to be personal financial advice or personal tax advice or, heaven forbid, personal legal advice. So anything, before you act on anything in this presentation, see a specialist such as myself who can take into account your personal circumstances before you act on anything that you hear tonight. That way. Okay. So since the 1st of July 2017, there have been a lot of changes. So we are now in SMSF 2.0. And that's a terminology we are familiar with from the IT industry, whether we use an iPhone or an Android phone, whether we prefer Macs or we like PCs. We're all familiar with these iterations of software. And the software developers tell us they've taken everything from version 1.0 that was great, transferred it to version 2.0, and made a few improvements. Now, I don't know about you, but I'm always a little doubtful about that hype. So let's have a look what's happened in SMS 2.0, whether it is better or not. So here are a few things that have not changed. You heard Grant speak about tax in self-managed super fund. So in the accumulation phase, we pay 15% tax on the investment income. When we're retired, we pay 0% tax. And I'll talk a bit more about that later, just so that everybody gets how significant that actually is. What's also still the same is when we can access our super. So if you are born before the 1st of July 1960, you can access your super when you get to age 55. You're born on or after the 1st of July 1964, well, I'm sorry, but you have to wait until you get to age 60. And if you're born in between, it's in between. What's also still the same is when we can retire. So if you're between ages 55 and 60, and you decide you don't want to be gainfully employed ever again, you can retire, and depending on your date of birth, access all of your super. Let's say you get to age 60 and you have more than one employer and you retire from just one job, then you can also access all of your super. So for example, one of my clients works as a pharmacist. So she has a number of different pharmacists who employ her, and she does locum work in a number of pharmacies. So she's turning age 60 just now. In November, she's turned age 60. So she's retiring from one of those pharmacies. She's keeping going with all the other ones. And she can access all of her super fund balance. Or if you wait until age 65, you have only got one employer, so this retirement at age 60 doesn't work for you. Wait till age 65, but you love your job like Grant. You can carry on working as much or as little as you like, and you can still access all of your super fund balance. So that's really pretty good. As Grant was saying, people in the US and in the UK, they are just amazed when they hear that kind of thing. So I really want to go on a bit more about the tax haven, because just to show you how significant that actually is. So here we have two guys who are both pretty lucky. They have 1.6 million in assets for their retirement. They do seem to have some issues with their backs, but hey, can't be all perfect. So one of these guys has his money in super. He's got investment income of 80,000, and as Grant already told you, how much tax does he pay? None whatsoever. He gets to keep the $80,000. The other guy, unfortunately, doesn't have his money in super, so he has to pay tax. Almost $20,000 goes off to the tax man, tax and Medicare. Now let's see the guys doing even better. So they had a super balance of 2 million, and we know we now have this 1.6 million cap. So even in super, we have to pay a little bit of tax, but it's only 50% on the investment income that is attributed to the excess over the 1.6 million. In his case, 400,000. So he doesn't pay tax on the 400,000, only on the investment income that is attributed to that. It's just $3,000. Pity though for the other guy who has it all outside of super, that's $27,000. He has to cough up in taxes. So again, even if you have to pay a little bit tax, if you're so lucky that we have more than 1.6 million, it is really not very much at all. Gets even better if we are now selling a large asset. Grant was talking about his brother who sold those shares. In this case, we are selling a property. bought the property for 400,000, we had it for 10, 15 years, worth 800,000. In the super fund, we get sale proceeds of 800,000, and we have other investment income of 80,000. How much does our guy get? 880,000. There is no tax to pay. The guy who has got the money outside of super, well, again, he has to pay $105,000 to the tax man, tax and Medicare. If we use the other example again with the 2 million, our guy in super has to pay a little bit of tax at 15% only, $11,000. The other guy, tax at the top rate, because he has got a total of $900,000 in cash coming in, $108,000 in tax and Medicare. So this is sort of the biggest thing to stress, is that the tax in super is only 15% or 0%. Outside of super, we start at 19% tax, plus Medicare of 2% is 21%, and we go up all the way to 47% when we sell a large asset. The other thing in a self-managed super fund is the flexibility. So we have great flexibility when it comes to investment choices. We can choose investments that are not possible in a retail or industry fund. The obvious one is property. In the self-managed super fund, we can have residential and commercial property. If you run a business, you can put that property in the self-managed super fund and lease it back to yourself. It can also be a relative who runs that business. You can lease it back to them and have the property in the super fund, get rent, pay tax only at 15% or 0% if you're in retirement. And then, of course, particularly important this evening, you can also buy unlisted investment in a self-managed super fund, such as those WA solar bonds that Warren will talk about a bit later. And the SMSF can still borrow. Again, that's handy if you buy something like property. Last but not least, there's greater flexibility in the SMSF when it comes to the withdrawals in retirement. If you control your bank account and all the shares and everything else that's in there, it's much easier to take money out than if you have to deal with somebody in a retail or industry fund. Oops, sorry, I'm going the wrong way. Costs. Now, the people who come to me about self-managed super, costs is generally not a major consideration, but it does feature somewhere in the deliberations. And so there's a rule of thumb that if a self-managed super fund or any super fund has more than $250,000, it is cheaper to have it as an SMSF than as a retail or industry fund. And that's because usually the retail or industry fund charge you a percentage on the value. So if you double your fund, you double your fees. So the higher up your balance goes, the more you pay, where it doesn't work that way in an SMSF. So that may be a small consideration, but it usually does feature somewhere in the deliberations. Now I want to talk about some strategies. And these are strategies we've used before, but now under SMSF 2.0, they achieve a greater significance, a greater importance. That was the word I was looking for. So here are two couples therapies that we use. One of them is contribution splitting. So if you make concessional contributions and you're not yet retired, you can contribution split up to 85% of the value of your limit, which now is $25,000, to your spouse. So in the past we've used that and contribution split to the older person on the grounds that the older person can access the money sooner. Now, under SMSF 2.0, we use contribution splitting to even up super fund balances between couples. So most of my super funds have got two people in them, and quite often when people are in their 30s, for example, one person might earn more than the other. One person might not be working while they're waiting for the children to grow up. And so one person's super fund balance keeps going up and the other one is not really keeping pace. Now that we have that 1.6 million cap in retirement, we really want to get to the stage where when people retire, you might only be in your 30s now, but you will get there eventually. So in 30 years' time when you retire, you really want to have each person to have their 1.6 million, then you can have 3.2 million all tax-free. You don't want one person to have 2.2 million and the other person 1 million, because then not everything will be tax-free because one person will be over the 1.6 million cap. So we can use contribution splitting to reduce that spouse's balance and move up the other one. Another strategy is if one member, the older member, goes into pension mode, so they can now withdraw money from the super fund, and we can withdraw that and recontribute it to the other spouse whose balance might be lower. So again, it's another strategy to even out uneven balances. pension withdrawal or lump sum commutation. So that's relevant for everybody who is in retirement mode. Now in this example, we have got a person who's got a pension balance account of $850,000. Now that's a long way off the 1.6 million. So you might think, why would he be concerned about the cap? The cap is now 1.6 million, and one of the new games in town is to create cap space. Why does somebody who's only got $850,000, a long way from the 1.6 million, have to worry about the cap? Will be explained in a minute. So it's the first year in retirement, and our guy is taking out $142,500. It's the first year he's retired. He's finally got some time to do all those modernizations to the house, build an extension, new kitchen, all that kind of thing, before the couple are going to settle down in retirement, and he needs a bit of extra money. So of course on the value side, his pension is going to go down from 850,000 to 707,500. But on the cap side, you see nothing happens. He started with 850,000, we reported that to the ATO, and the cap stays, even though he's taking money out. But we could do it like that. He could take out his minimum pension, that's the 42,500, and then he takes out 100,000, but we don't call that a pension, we call that a commutation. Nothing changes on the left-hand side, he's still taken out and spent 142,500. But on the right-hand side, you can see that he's now, the commutation counts and reduces his cap. So it's now 750,000. So why would this matter to somebody who is so far off the 1.6 million? Well, unfortunately, as we get older, we have two people in the super fund, there will come a time when one of them sadly passes away. This is how we started, and then eventually we grow old, and sadly there's only going to be one of us, and eventually nobody. So when one person leaves and passes away, the one who stays behind would of course like to keep everything in the pension environment, in the super environment, because we only pay 0% tax. We don't want to have to withdraw the spouse's amount outside of the super environment and then pay tax at way more than 19% if it's, $800,000 or $900,000. But if we've been creating cap space all along, if whenever we took more than the minimum amount, we did a lump sum commutation, we might be able to keep a lot, possibly all, of the spouse's super fund balance in the superannuation environment. And so cap space is now one of the important strategies that we look for when we look at people's super funds. Now there's a cheery topic, so let's just move on to something else. This is insurance. And so just to be clear, I'm talking about life insurance, which we know pays out when you die again. We have total and permanent disability insurance, where you have the any occupation element, which pays out when you're so disabled that you cannot do anything anymore. Now that's very difficult to prove to insurance companies who have very dim views on how this all works. And so you might think you're paralyzed from the neck down, but the insurance company is going to say, no, you could get a job as a stump licker. And you might think that is totally unrealistic, but the insurance company doesn't care. You can lick stumps, you can work. So that's why most people also take out own occupation TPD, because that means you get paid out if you can't do your own occupation anymore. And that's much easier to prove to an insurance company than the any occupation part. Income protection insurance pays out an income, a monthly income, if you're diagnosed with a specific illness or injury. And then we have trauma insurance, sometimes called critical illness insurance, which pays out a lump sum if you're diagnosed with a specific injury or illness. Now, some of you might have sort of thought, I can snooze off now because I've got insurance. I know all that. So you think you have insurance? Think again. First of all, some of you said you don't have a self-managed super fund, so you're in an industry and a retail fund. And most industry and retail fund, their default option is that they take money for insurance premiums. So you think you have cover, right? Well, if when you joined, you answered a health questionnaire, the kind of thing where they say, do you smoke? How many units of alcohol do you drink a week? In your family history, have people had? And then there's a list of illnesses for you to tick. If you did that kind of questionnaire when you joined, then you possibly have cover, but wait for the next slide. If, on the other hand, you're in your industry and retail fund, they take out premiums every month, but you never filled in a health questionnaire, then you actually don't have insurance. What you have is an indication of insurance. And so if a particular event happens, then the company looks at your health background. So you get diagnosed with breast cancer, you think you've got cover in your industry or retail fund because after all they're taking the premiums. You try and claim, then they assess you. And then they ask about the family history. And you say, yeah, my mother had breast cancer, she's fine now, yeah. My grandmother, yeah, she had breast cancer too. And the company says, sorry, we're not covering you. And you go, what? Well, then it's too late. So you thought you had cover, think again. Now, you've gone home and you've checked. And a lot of you are in self-managed super funds, so you know if you have cover because you would have done the questionnaire, the assessment, the blood test and so on. And for those in your industry and retail funds, you've gone home as well and you've checked. And you did fill in a questionnaire and you have insurance. So you think you're covered. Well, meet Tim and Bob. Tim and Bob didn't know each other, but they met a few weeks ago on a Sunday afternoon in the Joondalup Health Campus. So Tim is an avid golfer, and Bob loves gardening. And on a Sunday morning, they were both engaged in their favorite hobbies. And they came home at lunchtime and they said to their wives, I don't feel like lunch, I feel a bit funny, I'm just going to have a little nap. And the wives inquired, what's the matter? And they go, oh, I don't know, my chest, and my arm hurts, and my jaw is not feeling good. I'll just have a little nap. And so the wife says, no, we're going to the hospital. And Tim and Bob think this is all a lot of fuss over nothing. But as all the men in this room know, when there's an argument with your wives, who wins? The wife. So off they go to hospital. And that's where they met, in the emergency room, strapped to an ECG monitor. And the diagnosis for both of them was the same. They'd suffered a mild heart attack. So they was probably going to keep them in for observation. I don't know, there was some treatment plan, no doubt, and whatever. So Tim is a FIFO. He works for Rio Tinto up in the Tom Price mine, but a job that isn't physically too demanding, and the theory is, after a time he will go back to work. Bob, on the other hand, he works on a ship that lays those deep sea cables off the coast of the Northern Territory. A very physically demanding job, and he has to pass a medical every 6 months. So now with a mild heart attack, he's probably not going to pass the next medical, so he will not be able to work again in his own occupation. Tim and Bob have all the insurance, life insurance, DPD, income protection, trauma, the works. So they contact their respective brokers and they want to claim. Tim gets a check for $200,000 on his trauma insurance. He's insured for heart attack. And on the income protection, he has a waiting period, but if he's still sick when the waiting period is up, he will get his monthly income from the income protection policy. Bob, on the other hand, he gets a nasty shock. He gets a letter which says, very sorry, but you're not covered. Bob phones up his insurance broker, Paul, and says, what's going on? I've checked the policy. It says I'm covered for heart attack. So there it is, the devil. The devil is in the definitions. So on Tim's policy, it says heart attack is defined as having been diagnosed by a doctor and having an ECG test done. Bob, on the other hand, in his policy, a heart attack is defined as someone who subsequently needs a quadruple bypass. And as we know, Bob didn't need that. He isn't that sick. But he can never work in his own occupation again because he can't pass the medicals now. So he's getting nothing, because in his policy, the definition of a heart attack was you only get money if you have a quadruple bypass. So nothing for Bob. So this has been very much on my mind because I've got two clients who currently go through stage 4 cancer. One has got stomach cancer and the other one has got lung cancer. So this has been very much on my mind, and so I'm urging everybody to check their policies. Now, we at Sondergaard work with an insurance broker called Jade Burford, and Jade's undergraduate degree, her bachelor's, is in medical sciences. So she understands these medical definitions that are so important. So we send people to her for a free, no obligation review. She can look at the policy, see what the definitions are, and see if anything needs to be changed. So I've got one client, and they have a family history of multiple sclerosis and breast cancer. Now, she's perfectly fine, no issues at all. That's just the family history. And so what she does, what Jade organized for her, is she pays her insurance premiums to two different policy providers. There's one company, and they've got a really good definition for multiple sclerosis, so that's where some of the premiums are going. And the other premiums go to a different insurance company because they have got a really good definition for breast cancer. So that's possible. But you need somebody, an insurance broker, who understands those kinds of definitions. Otherwise, you might be like Bob. You have a heart attack, no money. Now, I would love to talk lots more about superannuation strategies. There are a lot more superannuation strategies under SMSF 2.0. We've got CGT relief for existing SMSF. We have lots of new contribution strategies. We have catch-up contributions for younger people or other people who have been out of work and not contributed so much. We have downsizer contributions for the over 65s. We have first home super scheme. There's changes to transition and retirement. The auto-reversionary pension has taken on a new importance under SMSF 2.0. But tonight is really mainly about Grant and the book launch, and about Warren and the WA solar bond he will talk to us about next. So, but if you would like, make a free, no obligation appointment with me, and I can review your personal circumstances. We can have a look what actually applies to you. In conclusion then, SMSFs are still the preferred wealth creation vehicle. We've been saying that for a long time, and that hasn't changed, because we still only pay 15% tax in the accumulation phase and 0% tax in retirement. Or if you're lucky enough to have more than 1.6 million, you might pay a little bit of 15%, and you saw earlier it wasn't very much at all. If you have the same investments in your own name, your tax liabilities are going to be much greater, which translates into less money in your pocket. So if you do nothing else tonight, then come and make contact with us, with me, and get a referral to have your insurance reviewed. And obviously I'll be happy to look at anything else as well. Thanks very much.